Hello and welcome to the Monday edition of Market Briefing. I'm Martin Bakkerdax, European business editor here at the IB Times UK. Well, we're looking at a pretty sharp contraction for European equity indices, falling around 1% across the board today. The main driver does seem to be that disappointing GDP print from China today. The National Bureau of Statistics telling us the Chinese economy expanded at a 7.7% pace in the first quarter of this year. That's slower than the fourth quarter of last year, which was 7.9, and well shy of the 8% that analysts were looking for. Now, industrial production, at least on first blush, seems to be the biggest driver of the slowdown, if you can call 7.7% slowdown. We should all be so sluggish in this kind of global environment. But nonetheless, it does raise concerns about the health of the global economic recovery. I think what some investors are going to look at in the coming days, however, is whether or not the slow figures, coupled with tame inflation, are going to allow the People's Bank of China to continue the impressive stimulus they've been putting into the economy over the past month or so. And if that is the case, we'll probably see a rebound in the second and third quarters of this year. We're still looking at markdowns for full year China GDP to about 8.3%, but nonetheless, these figures today are raising questions about the health of the overall global economy. Now, here in Europe, the Item Club of Ernst & Young issued its spring forecast for British GDP, and they do suggest that growth will luckily get to around 0.6% this year. That's a markdown from their figures in early January. But what was interesting is that underneath, they suggest that Chancellor George Osborne's programs to reignite the UK housing market will probably stoke consumer demand and lead to a domestic recovery, which is very different from the recovery the Chancellor had first pinned his hopes on, and that was one that was built on exports. And when you see what is happening with the China economy, you can understand why the export-led growth is going to continue to be questioned. Another fascinating thing we're seeing in the market today is a steep fall in the price of spot gold. We're testing $1,400 an ounce. It's fallen about 4% today, and it's down about 20% from its peak in late 2011. Now, that's a technical bear market, as analysts like to refer to, and it does suggest many things about the health of the global economy. In particular, it may suggest that the concerns about inflation being stoked by the stimulative efforts of central banks around the world simply aren't materializing, and as a result, investors are selling off gold, which they had purchased as a hedge against that. Now, what may also be happening is some price pressure as a result of reports that Cyprus may be willing to sell as much as around 400 million euros worth of gold in order to satisfy its part of the bailout that was negotiated a couple of weeks ago with the EU, the IMF, and the European Central Bank. But nonetheless, what is happening in gold is fascinating indeed, and it does seem, at least from reading some analyst reports, that 1,400 is a level that probably won't be held for very much longer, and we're looking at something in the low 13s before this bottoms out. We'll keep an eye on that, of course, and all of the developments around the financial markets on the economy page, which you can check us out, and we'll see you tomorrow.